Hello, this is Alan Kendall, and here we have 5 stocks in the Dow. I took the all the stocks in the Dow, and I took the percent net profit and the dividend yield. I added them together, and I divided them by the price to book. This is the Buffett formula, and what Warren Buffett considers value is the percent net profit. He calls this retained earnings, and he gives it special value. He believes it will grow the company over time. And the price to book he calls the margin of safety, because when it gets down below 1 here, like Chase and Bank of America, it gives some floor as to how far down the price can fall before a corporate raider will buy out the company and push the price up or take it over. And so we see here that Chase has a score of 28. That means that it should go up more than 5 times in price. And Travelers Insurance has a score of 12. It should more than double. We have here Intel has a score of 12. It should more than double. Some people are saying that they have this high dividend because they might be forced out of business because of competition, and we know that technology is a very difficult industry. Also, Cisco Routers is another stock that's technology that has a score of 10. So notice that here we also have Bank of America with a score of 12, but a very low price to book. They should probably also go up 5 times in price over the next 10 years. But when we look at these, we see technology and banks. And I really believe that the banks are going to just erupt in price in 2013. And the reason for that is when we look at the subprime loans, the Alt-A and option arms loans, in 7 and 8, we had 2 waves of subprime loans. In 9, they diminished, and then in 10 and 11, we had 2 more waves of Alt-A and option arms loans. And this is very, very important to compare with this following graph. We see here 6 sectors. We see here major sectors of the stock market, and of all the major sectors in the stock market, we see that 2 are really beat down here. And these are home builders and financials, utilities, technology, are all up higher than they were 6 years ago. And so since the median home prices has been rebounding in 2012, and the number of homes for sale has gone from 14 all the way back down to 4, we're seeing a rebound in price. In 2012, Fannie Mae and Freddie Mac almost completely ran out of foreclosures. Short sales are drying up. The shadow inventory is down from 3 million to 1.1 million bank owned, and also the seriously delinquent are down from 2.2 million to 1.6 million. So we see here that I believe that financials, and if we look back at this graph here, we see that in the Dow, 3 of the stocks that are beat down are financials: Travelers Insurance, Chase, and Bank of America. And I think that's really the place to be, would be into financials and also in home builders, because the Alt-A, option arms, and subprime loans almost completely quit resetting around October of 2012. We should expect a massive price increase in financials and home builders as their earnings go up. What will happen is over the next 3 to 6 months, around the middle of the year of 2013, the earnings will increase, and there'll be less money spent on foreclosures. Home prices will continue to go up, and home builders will start to make more money. And so that's why I believe that home builders like KB Homes and Our Homes and these stocks here, Travelers Insurance, Chase, and Bank of America, are 3 good stocks to buy, because they will go up just with all the other, just because they're part of all the other mutual funds, and I believe that their earnings will go up as well. And so I believe those are great buys for 2013. So have a nice day. Bye-bye.